Oracle's Q4 was not a simple beat and rally story. The company delivered $19.184 billion of revenue, non-GAAP diluted EPS of $2.11, and another eye-catching signal that AI infrastructure demand is running through the business. But the stock still fell 8.5% on June 11 because investors were not only grading demand, they were grading the cost of delivering that demand. The central read-through is this: Oracle's AI backlog surged, but capex fears dominated. For retail investors, the question is not whether Oracle has demand. The question is whether the company can turn that demand into durable, high-return earnings and cash flow without asking shareholders to absorb too much financing risk. Start with the scorecard. Revenue came in at $19.184 billion, above the $19.09 billion estimate, a beat of about 0.5%. Non-GAAP diluted EPS was $2.11 versus an adjusted EPS estimate of $1.89, an 11.6% upside surprise. GAAP net income was $4.304 billion, up 26% year-over-year, but treat that as reported profit context rather than a clean consensus comparison. The reported quarter was strong enough on the headline numbers. The market reaction tells us the debate moved beyond whether Q4 beat. Investors are now asking how expensive the AI growth curve will be and whether the earnings upside can keep outrunning the capital intensity. The revenue mix explains why the bull case still has fuel. Total revenue grew 21%, and cloud was the engine. Oracle reported $9.913 billion of cloud revenue, up 47%. That is now more than half of quarterly revenue, and it changes how investors should read the company. Software was still large at $6.824 billion, but it declined 2%. Hardware contributed $924 million, up 9%, and services added $1.523 billion, up 13%. So the company is no longer being valued only as a legacy software compounder. The market is being asked to value a cloud infrastructure expansion story layered on top of the software base. That is powerful when demand is visible, but it raises the bar for execution. Profit quality was solid on the income statement, but not frictionless. Operating income was $6.133 billion, up 20%, almost matching the 21% revenue growth rate. That suggests Oracle did not give away the quarter to chase growth. At the same time, operating expenses were $13.051 billion, also up 21%. Research and development was $2.613 billion, sales and marketing was $2.068 billion. General and administrative expense was $444 million, and other operating expenses were $1.254 billion. Below operating income, net other expense was $763 million, and tax expense was $1.066 billion. The final GAAP net income number, $4.304 billion, shows earnings power is real. The investor concern is whether future infrastructure spending pressures the path from revenue growth to shareholder returns. Guidance is where the demand story gets louder. For Q1 FY2027, Oracle guided total revenue growth of 27% to 29% in both US dollars and constant currency. Using the reported Q1 FY2026 revenue base, that implies roughly $18.956 billion to $19.254 billion of revenue, with the midpoint sitting slightly above the cited $19.09 billion estimate. Management also guided total cloud revenue growth of 58% to 64%, a sharp acceleration from the 47% cloud growth reported in Q4. On earnings, Oracle guided Q1 FY2027 non-GAAP EPS of $1.72 to $1.76, above the cited Wall Street estimate of $1.68. For FY2007, management confirmed $90 billion of total revenue guidance and raised official non-GAAP EPS guidance to $8.05. The market setup was already tense before this report. Over the one-year daily close window ending June 12, Oracle's close moved from $215.22 to $184.13, a decline of 14.45%. The closing high in that period was $328.33. and the closing low was $136.48. Around the earnings event, the selected options data showed an at-the-money straddle implying a move of about $10.55 or 5.73% around the $184.13 spot price. The actual post-report rate was harsher. The stock fell 8.5% on June 11 despite the revenue and non-GAAP EPS beats. That is a classic sign that expectations were not just about the quarter. They were about capital requirements, financing, and credibility of the AI build-out. For valuation, use the PE framework as a scenario tool, not as a price target. The channel's proprietary reasonable PE range for Oracle is 30 to 40 times, with 35 times as the midpoint. Yahoo Finance forward EPS estimates in the analysis are $8.03 for the fiscal year ending May 31, 2026, and $10.87 for the fiscal year ending May 31, 2027. Keep the basis distinction visible. That $10.87 is a Yahoo Finance forward EPS estimate used for a market framework. It is not the same item as Oracle Management's official FY2027 non-GAAP EPS guidance of $8.05. At the current price of $184.13, the framework produces bands of $240.90 to $321.20 on the current fiscal year EPS estimate, and $326.10 to $434.80 on the next fiscal year EPS estimate. The debate is whether the market should trust those forward earnings assumptions while capex and financing needs are rising. Management's commentary points to the source of both excitement and concern. Oracle reported remaining performance obligations of $638 billion, up $85 billion sequentially, and said large AI contracts drove most of the RPO increase in Q3 and Q4. That backlog is the cleanest evidence that AI infrastructure demand is not theoretical, but the funding side matters. Management also said fiscal 2027 financing needs would be about $40 billion, including the previously announced $20 billion equity issuance, while saying it did not expect more debt issuance in calendar 2026. The core risk is conversion. Can Oracle turn massive AI commitments into durable, high-return cash flow while funding very large data center requirements and potential equity dilution? The takeaway is balanced but sharp. Oracle beat on revenue, beat on non-GAAP diluted EPS, guided strongly for Q1 FY2027, and showed enormous AI backlog momentum. Yet the stock sold off because investors focused on the cost of that growth. For long-term holders, the key monitor is no longer just cloud revenue growth. It is whether Oracle can convert RPO into profitable revenue, protect earnings quality, and finance the AI build-out without eroding shareholder value. AI backlog surged, but capex fears dominated.